Hey, what's up guys? John here. Big investors are doing something that everyone needs to pay very close attention to. One of America's largest landlords, Blackstone, has halted withdrawals. They're not letting investors get their money out for the seventh straight month. Now, the last few years, we've seen so many people raising so much money to invest in multifamily, even large-scale single-family office buildings, farmland. They're just buying. But now the tides are turning and we're starting to see something really shocking. And I believe we're going to see a huge opportunity for investors to be able to step in and pick up some really good deals. In this video, I'm going to walk you through what's really going on. I mean, it's unbelievable. Another investor just lost 3,200 units to foreclosure because of these increased interest rates. If the big guys are getting hit, then everyone else is going to see what's going to happen to the general public. The general public, they don't have the discretionary income like these big investors. However, when we start to see these huge portfolios of mom and pop properties start to trade hands, it's going to be an opportunity for you to go out there. Maybe you're renting right now to pick up your first deal or a second deal. Maybe it's an opportunity for you to go out there and maybe even raise money with some friends and family to pick up distressed real estate. There's going to be opportunity, I can promise you that. Please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people. And if you want to fix your credit so you can get financing, so you can position yourself in a really strong way for this big wealth transfer, we'd love to help fix your credit at greatcreditfast.com. That's greatcreditfast.com. Schedule a free consultation. Take a look at this. So Blackstone limits withdrawals from real estate income trust for the seventh straight month. Blackstone's $69 billion retail real estate fund curbed investor withdrawals for a seventh straight month in May as it continued to see outsized redemption requests. The Blackstone Real Estate Income Trust, known as the BREIT, said it received $4.4 billion in redemption requests in May and paid out 30% of those requests to investors, or $1.3 billion, according to a notice posted on the BREIT website. Now imagine you invest in a real estate fund and they promise you 6%, 7% return, 8% return. But you're looking out there, everything is expensive. Everything's going up 10, 15, 20%. And they say inflation's 6%. So in a best case scenario, you are getting a break-even investment. So you're going into this real estate market getting no return on your investment, knowing in reality that you're likely losing money by being associated with that fund because inflation is going through the roof and it's likely much worse than what they're reporting. And so investors are looking at this saying, you know what, I'm way better off sitting on this money and getting ready to pounce and invest into something else than just waiting for years for this to hopefully pan out for them. Or for me. The redemption requests in May were down slightly from the $4.5 billion in April, the change from March, and up from $3.9 billion in February. Now, on Bigger Pockets, they talk about and this is a real estate website, talk about an investor that loses 3,200 units to foreclosure, and they said low-income housing, it's always the poorest of the workers who feel it. I wonder if they used arms with no principal payback loans when the interest rates rose. And that's what I heard as well, is that basically as interest rates rose, their costs just continued to skyrocket, and their cost, they bought it at like a 5 cap and their cost skyrocketed overnight, and they just had to give all of the buildings back to the bank. All the investors got completely burned. Variable rate loans. He heard the same thing. From what I heard, these allegedly were variable rate loans with no cap, meaning the price could go through the roof. Properties were allegedly purchased at a cap rate under 5%, and the sponsor experience was allegedly questionable. Investors allegedly lost it all. Plus, bonus depreciation was taken. Now investors will have to pay back that to Uncle Sam. So these investors got absolutely hosed. And there's a lot of really big syndicators, a lot of big names. You're probably thinking of some of them right now that have a lot of variable rate loans on their properties, a lot of companies that have variable rate loans on their properties, that if Jerome Powell continues to increase interest rates, it's going to push these syndicators off cliff's edge. And if we look at job numbers, we look at inflation numbers, we look at what's happening with wages, it's all indicating that we're going to see further interest rate hikes. Right now, investors lost money on 14% of homes that they sold in March. 14%. In the last few years, everybody wanted to be a house flipper. Everyone was in real estate. Now, I personally love real estate. I think real estate is going to be a massive opportunity. And I think we're going to see a lot of people that are going to pick up incredible deals in the next couple of years. But I think there's also a lot of people that are holding on to properties right now that they don't want to be in, or maybe that they overpaid for, hoping to find a way out. And that's not a place where a lot of people want to be right now. Real estate investors are retreating from the housing market at a record pace. Home purchases by real estate investors fell 48.6% in the first quarter from a year ago, the largest annual decline since Redfin began tracking records in 2000, right? In 2000, the largest decline in 23 years. The group's retreat surpassed the market's overall 40.7% decline in purchases as elevated interest rates plus declining rents and home values pulled down profitability. Declining rents. Now, I reported on declining rents coming over a year ago on this channel, saying that we are going to see really big declines in rents. We haven't yet seen them to the capacity in which I think they're going. We've seen them in a lot of areas down 4%, 5%, 6%, some down 2%. Now, some people say, no, not my market, John, not my market. What people don't realize is that this is happening gradually. We have so many people that have these properties. Investors, people that, even home builders, they're sitting on 1.7 million new housing units that are going to be coming to market. They're not going to be able to find buyers for $400,000 or $500,000 or $1 million like they were intending at 3% interest rates now that rates have essentially doubled, right? People are they're going to likely trade these properties to private equity firms that are going to turn them for rent. There's going to be so much inventory and supply and demand. We're going to start seeing prices come down, which is going to put even more pressure on a lot of these real estate syndicators and a lot of these investors that picked up these huge deals, these massive, massive deals that they're going to have to start declining their rents, decreasing their rents, yet their costs are going to continue to rise. And the conditions also prompted investors to focus on more affordable properties. Now, Blackstone raised the biggest real estate fund in history, and one of their key areas of focus is single family. Now, I believe they are going to, and many investors are going to, focus on properties priced in the $80,000 to $100,000 to $150,000, all the way up to about $400,000. Because as we start to see the economy contract and we start to see people scramble, you're going to see people in the $500,000 to $600,000 price point look to downsize. You're going to see renters that are going to try to become homeowners. They're going to try to enter this market. You're going to see all people that are inside just holding on, inside that price point, holding on. So there's going to be a lot of focus on that price point. And that focus is going to allow them to have pricing power. They're going to be able to have more options. And I think we're going to start to see a lot of these institutional investors buying up blocks and blocks and blocks of these homes, and they're using technology such as apps and other software and virtual assistants and all of these different new benefits, technological benefits, to manage these properties nationwide that weren't available 5-10 years ago. While investors have pumped the brakes on home purchases, they're still scooping up bigger shares of homes than they were before the pandemic, which can create challenges for individual buyers at a time when there's so many few homes for sale. Redfin senior economist said in a report, investor purchases accounted for 17.6% of the market, down last year from peak of 20%, but still the second highest rate since data collection began as individual home buyers are becoming priced out. Mortgage rates shot up in the wake of the Federal Reserve interest rate hike, and they're saying it's about 6.63%. It's higher than that. Now it's higher than that. When you hear these numbers, like, in the mid sixes, they're looking at a borrower that has an 800 credit score. That is, it's not going to be the median type of borrower where it's just like the average borrower. The average borrower has a credit score just below 700. They're looking in the mid sevens, possibly high sevens, and I've even seen reports on Google and other searches saying in the low eights. So you're not getting in the mid sixes for most people, unless you have, perfect credit, really low debt to income ratios, strong job history, great tax, everything is like perfect. It's going to be hard to get that in the mid sixes. Despite often using cash, investors are also affected by higher rates as they depend on non-mortgage loans to fund renovations and related expenses. Plus, if they're paying all cash, they want to receive benefits for paying all cash, right? They want to get a yield, a premium on their investment if they're going to put down all cash. The downtrend may continue to extend into the second quarter, given that investors find it more costly to borrow as the economic uncertainties persist. Redfin predicted that this may prompt some investors to move into other asset classes such as stocks and bonds. During the pandemic, investors were active in the housing market, taking advantage of low interest rates and immense demand. But in March, 13.5% of homes sold by an investor sold at a loss, with the share rising to 20.8% for home flippers. So home flippers are getting absolutely smacked right now. And I think that is going to persist. And the reason for it, you think about the home flippers business model. They go into a neighborhood. They want to buy a property that needs work. They fix it up, they renovate it, and they list it for sale. But as the economy contracts and people have less disposable income, are they going in and they're trying to buy brand new homes? No. They're just trying to get into the neighborhood. They want to get into the neighborhood, and maybe they fix it up over time. Right? They're really cautious of how much money they're spending. They're not spending $50, $100, $200,000 over asking, waiving contingencies like they were in the past. And all these home flippers that are sitting on all this inventory, they need to get it off the books, because if they're paying 10, 12, 15% hard money, I mean, it's going to be hard for these people to hold on, right? So they're going to start turning away and maybe even putting these properties up for foreclosure, short sales. They're going to just accept losses. Times are changing. With times changing, opportunity is coming. Immense opportunity is coming. So if you're a renter right now, you're in a situation where you are looking to, 5x, 10x, 100x your net worth, the opportunity is going to be in the next few years to do it. Like after that, I think it's going to get much, much harder. Mainly due to automations, due to robotics, due to technology, due to everything that's happening in the world. There's like a short window in front of us to make really, really smart decisions. And if you make smart decisions, you'll be set for the rest of your life. And I think your family will be set as well. I think there's going to be really, really big opportunity, especially in real estate. If you want to fix your credit, you want to put yourself in a really strong place, we'd love to help you. Give you a free consultation at greatcreditfast.com. That's greatcreditfast.com. And give us a call, 561-430-5900. And subscribe here. Also, add me on IG for short form content and content I won't post here. Catch you guys in the next video.